This is Boom Bust, and these are some of the stories that we're tracking for you today. It's day 2 of the BRICS summit in Fortaleza, Brazil, and some big news coming out of there this afternoon. You'll definitely want to hear what's been decided upon there and what it means around the world. Some big news. And Victor Shih is on the program today. The professor of economics at UC San Diego is giving us his thoughts on an emerging markets development bank and reserve fund. And in today's Big Deal, Edward Harrison and I are discussing what a slumping crude price means for the strength of the U.S. economy. It all starts right now. The BRICS are making some big moves on day 2 of the summit in Brazil. Leaders from Brazil, Russia, India, China, and South Africa have signed off on a new development bank. According to leaders from the 5 BRICS nations, the bank shall have an initial authorized capital of $100 billion, with the initial subscribed capital at $50 billion shared equally among its founding members. And what are the facts? Well, here they are. The new development bank will be located in Shanghai. The first chair of the Board of Governors will be from Russia. The first chair of the Board of Directors will be from Brazil, and the bank's first president will be from India, while the African Regional Center will be in South Africa. Now, the BRICS also announced the signing of a treaty for the establishment of a reserve fund for member nations called the Contingent Reserve Arrangement, or CRA, with an initial size of $100 billion. The Emergency Reserve Fund will help developing nations avoid, quote, short-term liquidity pressures, promote further BRICS cooperation, strengthen the global financial safety net, and complement existing international arrangements. RT's Paul Scott is covering the summit from Fortaleza, Brazil, and has a full report from day 2. Paul?
This is going to be initially worth around $50 billion US, with each country putting in around $10 billion each. Now, it's seen as a rival, an alternative to the International Monetary Fund and to the World Bank, which the BRICS nations, and Russia in particular, feel are too Western-centric and in particular too Washington-centric. So this new development bank is going to be seen as an alternative, a rival to that the current global financial structure. Now, on top of this, there's also to be a new reserve fund worth around $100 billion US. Now, this will protect the emerging countries from any possible future global financial crisis. It's going to be seen as a buffer to protect them if there is a global financial crisis in the future. Now, the hope is that the BRICS nations can continue to grow and act as a counterbalance to the economic power of the West, and in particular, as I mentioned, Washington. Now, Russian President Vladimir Putin has spoken of what he wants, which is a multipolar world in which the global economy isn't so Western-centric and isn't so dependent on the US dollar. So the signing off of these 2 initiatives is seen as a step towards creating that new economic world order.
That was RT International correspondent Paul Scott in Fortaleza, Brazil. BRICS are a motley crew of emerging economies that have different economic and political systems, but they're trying to figure out multilateral ways to foster economic cooperation and growth. We sat down earlier with Victor Shih, professor of economics at the University of California, San Diego, to learn more about what China is looking for at this summit. China is one of the biggest players in the BRICS and arguably the world. Now, I first asked him if the negotiations about an emerging markets development bank and reserve fund were significant, and obviously they probably are going to prove to be, but here's what he had to say.
The way that they're talking about it seems like it's going to be a very large-scale developmental bank. The one thing that I think people should be cautious about is that, whenever the government comes in and invests too much money, I mean, of course, there is a time and a place for government investment, but when we're talking about hundreds of billions of dollars, people would be worried whether, this investment is going to bear a sufficient return. And in a world where interest rates are beginning to rise again, I think it's going to be very challenging for these developmental banks to earn a yield that's sufficient to repay the debt that they're going to need to raise.
Now, what about reserve currency status? You know, who in the emerging markets can vie for increased reserve currency status over and over what time frame?
Yeah, you know, among the emerging market countries, of course, people can say, well, the renminbi clearly is a candidate for being a reserve currency for the rest of the world. But of course, you know, in order for that to come to fruition, I think China needs to carry out substantially more financial reform. I mean, for one thing, and probably the most important thing, the renminbi is not a freely circulated currency. So the capital account in China is still closed so that people cannot move renminbi into and out of China freely. And that's a really big barrier to the renminbi to become a reserve currency. There are also a whole host of legal and economic institutional reasons for why the renminbi is still not quite ready to be a reserve currency. You know, for example, there has to be a lot more transparency in the budgetary process of China. You know, as messy as the U.S. budgetary process is, it's actually, you know, pretty transparent, and the whole world can see Republicans and Democrats debate about the budget, you know, on TV. That's not something that you can see in China. And so people are, you know, sometimes in the dark about the budgetary process in China, especially when it comes to local debt, which is, of course, implicitly guaranteed by the central government. It expands extremely rapidly without anyone in the world really noticing it. And it seems like the Chinese government deliberately tries to hide the debt. So until you have transparency, until you have capital account opening, you know, renminbi is still just not ready to be a reserve currency.
Now, Victor, many people see the BRICS as representing a sort of emerging market elite or emerging market leadership. And this is a question I've had for some time, and I'm sure that you can answer it. What exactly makes a country an emerging market? And in what respect are the BRICS leaders of emerging market countries?
So, you know, I guess traditionally emerging markets are just, you know, countries that are not that rich. I guess,
Yeah,
you know, it's a very simple definition. On a GDP per capita basis, and indeed, and then what makes the BRIC countries sort of the powerhouses among the emerging market countries is just the simple fact that they're large. You know, they're all fairly populous countries, led by India, of course, which has a population of 1 billion. And there's, you know, in some of those countries, there's a substantial amount of human capital, right? So India, Russia, of course, you know, enormous amount of high-end human capital because of the great education system in the Soviet Union. So that's what makes them powerhouses. But I think people also, I think the BRIC countries are actually quite different from each other, though. So I don't agree with this typical practice of lumping them all together. Brazil and India are democracies. Russia and China are not so much democracies. You know, we can debate about the degree to which they are or not democracies, but they're clearly very different from Brazil and India, where the public plays a very substantial role in public policies in these countries. And in Russia and China, clearly the public plays a less role. Of course, you know, as I touched on already, in case of transparency, there's just a lot more transparency in, you know, just focus on economic issues in the budgetary process, in monetary policy, in all kinds of economic policies in India and in Brazil, a lot more transparency than in Russia, than China. And of course, you know, Russia and China also do maybe partly compensate for the fact that they don't have a lot of transparency. They keep large foreign exchange reserves. And that has actually provided them, you know, a large degree of stability in terms of their exchange rates. You know, much more so in China than Russia, of course, but even the Russian foreign exchange reserve has helped it. So I think they're quite different. You know, I think it's helpful for them to have a meeting and talk about like common objectives, but there are also divergent objectives, I would think.
Victor, I want to talk about China here. Now, would you walk us through the main reforms announced during last year's third plenum and tell us if they're significant and achievable?
So there, you know, the third plenum of the 18th Party Congress of the Chinese Communist Party, of course, right? So people sometimes talk about the Third Plenum as if it's like the Federal Reserve meeting, but it's actually a Chinese Communist Party meeting. They sort of decided on a fairly comprehensive plan for reform, although quite vague. They have carried out some very important policies promised at the Third Plenum already. For example, relaxation of the one-child policy. So I believe in all the provinces in China, they have rolled out policies to allow more couples to have 2 children instead of 1. So not even all couples can have 2 children yet, but more so than previously was the case. But some of the other sort of issues that were discussed in the Third Plenum have not been carried out yet, and it doesn't look like they will be carried out by the same extent as people had hoped. So for one thing, there was talk of giving property rights, land property rights to farmers so that they can freely sell and buy land. That policy has been put aside completely. There was some wording on encouraging what's called hukou reform, so allowing people to move into a city and receive social services in that city. The central government has since made clear that there's going to be a very strict limitation of migration into major cities like Beijing and Shanghai. So that's yet another reform that's falling short of expectation. Finally, and I think this is the big one that everyone's waiting to see what happens, is what's going to happen to state-owned enterprise reform, whether they're going to be allowed to go bankrupt or privatized. That's a big issue still under discussion right now, and I think a lot of people are watching to see how far they're going to push for state-owned enterprise bankruptcy or privatization.
That was Victor Shih, professor of economics at the University of California, San Diego. Time now for a very quick break, but stick around because when we return, Jim Bruce, the brains behind the film Money for Nothing Inside the Federal Reserve, is giving us his thoughts on possible options open to the Fed in terms of exiting the monetary experiment that it's been engaged in. And remember, you can see all segments featured on today's show on YouTube, youtube.com/BoomBustRT, and on Hulu, hulu.com/boom-bust. Now, before we go, here are a look at some of your closing numbers at the bell. Come on back with us.
Are you like me? Do you want your comedy news with some teeth? Want your comedy news to be a bare-fisted, no-holds-barred fight to the death? Like a truth vampire biting into the necks of the corporate elite and the billionaire freaks while they're going, make it stop! Well, that's what you get with my new show, Redacted Tonight.
Was that too much? I think that was too much.
What are your thoughts on what's been going on in Washington?
Well, it's a mess, Larry. I mean, the whole country is being scoffed at and laughed at.
Enough is enough.
The media, the candidates, the corporatocracy. Covering issues that actually affect you and me doesn't do too much for ad revenue.
Biotech agriculture giant takes on a 76-year-old American farmer based in Indiana.
How much fallout do you think this is going to create for the CIA?
Do you think this is what's triggering the crisis?
America's the largest economy in the world. It's also the largest debtor nation in the history of the world.
Breaking the set is mostly about alternatives to the status quo, but one that gave real alternatives a voice.
One minute they were working toward the American dream, the next they were just trying to survive the night. It's time for Americans and lawmakers in Washington to wake up and start talking about the real causes of poverty in America.
Welcome back to the show. Now, the financial crisis put the Federal Reserve on a wild path of monetary experiments. The various quantitative easing programs and near zero interest rates that the Fed has embarked on in this new monetary journey has, some way now put the economy in a different place, and now it's time to steer the economy back to a place of getting stronger. It has to figure out a way to exit all of these strategies and has to do this without creating some unintended consequences. To get more on the possible options open to the Fed, I spoke to Jim Bruce, the brains behind the documentary film Money for Nothing Inside the Federal Reserve. I first asked Jim if he supported the Fed's move away from quantitative easing. Here's what he had to say.
I think what's curious is the Fed waited, as we've seen recently, U.S. GDP has been widely negative recently. So I think the Fed, the timing of what the Fed is doing is a little bit strange if you look at some of the variables that they're supposed to be watching, like economic growth. But I think it's long overdue. I think they waited far too long to do what they're doing. But I certainly agree with stopping QE at this point. I think the Fed's recognizing by what they're saying that the upside potential for further QE is zero, essentially. They've run out of benefits. They're worried about the risks, so they're unwinding the policy.
Jim, Yellen did say that, quote, I'm going to read another quote to you. Given the economic situation that I just described, we judge that a high degree of monetary policy accommodations remains appropriate. So despite ending QE, low rates will remain in place for some time to come. So are you concerned that this will have negative unintended consequences as well?
Yeah, I mean, I think that's the Fed's trying to walk a fine line. They're trying to say, okay, we're done with QE, but what they're worried about is the market overreacting to that and starting to sort of collapse because they know the market's been propped up by QE. So the idea is they're going to sort of hand off from QE over to 0% interest rates. And the reason to not sell stocks and things like that and to not have a big risk-on period in the market is, with QE gone, is now, oh, we'll have an extended period of low interest rates. So that the Fed, it's a very delicate line they're trying to walk. My concern all along is the Fed shouldn't have made these promises to the market in the first place. And now they're trying to sort of manage a gentle, graceful exit from this position they put themselves in.
But what about macroprudential regulation? Can't the Fed deal with market froth by regulation the way that New Zealand has successfully done and the British are now doing?
I think maybe theoretically, but if you look at the areas that the Fed is willing to acknowledge where there's problems, the leveraged loan market, high-yield bond market, some areas of the stock market, those are tricky areas. I think the leveraged loan market, they are trying to take steps in to sort of damp it down. But I think in general, so much of the playbook the Fed has developed for the things they'll do to resist a bubble if one happens again is looking at the bubble that happened in 2003 and 4 and 5 and 6 in housing prices. And so they have these clear steps. If we see a big, huge housing bubble and a massive U.S. credit bubble, these are the things that we can do as regulators. But again, they're fighting the last war. I think they're not seeing the risks that are currently on the horizon, and I don't think they have very good tools to adapt to what we have right now, which I think is overpriced stocks, bonds, and houses on a sort of global basis. I mean, it's London real estate, New York real estate. There's sort of big problems that the Fed has, and I don't think they have tools to deal with it, and I don't know if they have the willingness, because if the Fed's going to sort of take the punch bowl away from this party, it's going to slow economic growth. And I think they're so scared of slowing down economic growth because it's so weak that I don't think they're really going to take any steps to really regulate any of the problems that I see on the horizon away.
Jim, I'm going to play devil's advocate here. If the Fed doesn't keep rates at zero, won't the U.S. economy weaken and then perhaps tip into a recession?
I think that's probably, that's a potential and likely historic outcome. I mean, again, my problem is I would have allowed interest rates to rise maybe several years ago when the economy probably could have withstood it, more easily. So I think that is a risk, but I think, to me, what the Fed has done, really, they haven't really caused healthy economic growth or a strong economic recovery in the U.S. We haven't seen any of those things for the last 6 years. What they have caused is a big boom in financial assets. And I think today was day one of the Fed, Janet Yellen, specifically recognizing that there are risks in the bond and stock markets in the U.S. And I think that's sort of turning the page to a new chapter. And I think what the Fed is trying to do is begin to distance itself from what it's been doing for the last 5 or 6 years, which is talking up financial assets, talking up financial markets in an effort to get economic growth. And I think the risky thing is exactly, as you're pointing out, they're pulling away, taking away the punch bowl. They're beginning to talk about tightening at a point when the economy is not growing because their policies haven't worked. Their policies haven't led to growth. So now, as they remove their policies, there is a further risk to growth. So I agree with you that there's a risk. The problem is I think the Fed has to think about the big picture and the long term. And I think they are slowly realizing what I would have, said 3 years ago, which is continuing to promise QE and promise 0% interest rates forever creates expectations that are dangerous in the markets. And now I think the Fed is going to have to deal with those expectations over the next, year or two.
Jim, here's another question in the vein of my previous one. What about the Fed's congressionally authorized dual mandate, this little thing, to promote not just price stability, but also full employment? You just mentioned employment. How can the Fed put on the brakes now when we're not even close to full employment?
I think that's the big problem. I mean, if you look at there's a distinction between what the Fed is trying to do and what it's actually doing. I think the Fed's been trying to impact growth and employment for the last 5 or 6 years, but what they've really been doing in reality, their policies have been impacting financial asset prices and pushing up asset prices, stimulating financial markets. And the idea is always that that would then lead to healthy, sustainable growth and employment. But since it hasn't led to healthy, sustainable growth and employment, the Fed is left with the conundrum right now of they're seeing that financial assets have been pushed to dangerous levels. Janet Yellen's admitting that finally publicly. And so they're realizing that they have to slow down on QE and these policies that are pushing those assets higher.
That was Jim Bruce, director of the documentary film Money for Nothing Inside the Federal Reserve. Time now for today's Big Deal. Time with Edward Harrison. Good to be in the flesh today. Yeah. Now, in today's Big Deal, Edward and I are discussing what the slump in crude oil prices means for the strength of the U.S. economy, especially in light of Fed Chair Janet Yellen's remarks today at Congress. Okay, so Ed, this is a very, very macro big deal that we're going through today. So I want you to walk me through it step by step, because this is some big stuff. But, first thing, what did Yellen basically say today in her report to Congress?
She said basically, even though actually we're tightening, we don't want you to think of us as tightening because we're just removing the excess accommodation that's associated with QE because we've become uncomfortable with that. But we're still going to be accommodated by having zero rates for as long as it takes.
Now, how did inflation, unemployment, and future Fed rates basically appear in her remarks today?
Basically, she said that inflation isn't becoming unanchored, so that gives us accommodation. Unemployment is still not where it should be. There's excess capacity, there's slack in the labor market, and the two, when you combine them together, given where we are in the economic cycle, we feel like we, the Fed, that we need to be more accommodative.
Now, what did she say about, the markets kind of regaining strength and growth happening anytime soon? What were her remarks there?
I think that she was a bit concerned about, or she gave lip service at a minimum to the concept that there was froth in the equity markets and credit markets and so forth. But generally speaking, I think that she's much more concerned about the real economy than the other side of the economy, that is the financial economy. She feels like her remit basically is a dual mandate for full employment and for, price stability, and that's all she's going to focus on.
Now, actually, on the subject of financial stability, I want to highlight some of her remarks from today. Now, here's a quote from Yellen today. The committee recognizes that low interest rates may provide incentives for some investors to reach for yield, and those actions could increase vulnerabilities in the financial system to adverse events. While prices of real estate, equities, and corporate bonds have risen appreciably and valuation metrics have increased, they remain generally in line with historic norms. So can you break this down for me? Basically, does Yellen think that there's froth in the markets? I think.
Yeah. So she's saying that there is some froth in the market, but I'll pay some lip service to the whole concept that we should be thinking about whether or not what we're doing is being overly accommodative in creating that froth. However, and now that I've said that it could be, in fact, it's not. These are within historic norms. And remember that stock prices have tripled since the 666 on the S&P. We're at 2,000 now. That's a 200% return for anyone who invested over the last 5 years.
That's kind of incredible. Now, the Fed, it generally sounds pretty optimistic about future growth. And, some contradicting indicators, though. We have crude oil, the WTI oil price, and, this record-long slump that we've seen, basically.
Right, yeah.
So can you tell me what's going on with the price of oil? What's this all about?
So basically, if you look back to 2008, what you saw is oil going up to 147 WTI. That was the sort of thing that created demand destruction. If the economy is actually doing incredibly well on a global basis, you would expect, therefore, there to be all sorts of, people going out and actually using oil, and therefore there will be some constraints. But that's not what we see for WTI. We don't see that for Brent, which is what they have in Europe. In fact, WTI is below 100 now. It had that 10-day slump in a row. All of those signs are pointing to weakness from a macro perspective, as opposed to strength. And the Fed is tightening into that weakness.
So basically, these oil prices, they don't mean, they're not a good thing. I would think that there'd be an excess supply and prices are going down. That's not the case that you're saying?
From a consumer perspective, it's a great thing that it's going down. Gasoline prices are going down. It gives consumers a little bit extra money to spend. But from a macro perspective, it's a sign, it's a signal that, the economy is not ticking over. There's no chance of overheating in any way, shape, or form. So that means that if the prices are going down, you should look for coincident indicators that are saying the exact same thing. For instance, food prices are also going down. Other commodity prices are going down. So none of those things speak to an economy on a global basis which is actually trending upwards. If anything, it shows weakness in the global economy.
Whew, exciting stuff. Happy time. Signaling weakness all around. Ed, thank you as always. That's all for now, but please drop us a line because we love hearing from you on our Facebook page, facebook.com/BoomBustRT, and please tweet at us at AaronAid, at EdwardNH. From all of us here at Boom Bust, thank you for watching. We'll see you next time. Bye.